Sriram Krishnan has over 26 years of work experience, a large part of which has been in the Indian capital market space across asset management and security services. Sriram sir's experiences varied across sales, client relationships, a large and of product operations, finance, through his stints across global organizations such as Franklin Templeton, HSBC, Citibank, and Deutsche Bank. In his previous roles, Sriram sir had had the opportunity to work closely with both domestic and foreign investors, issuers, market infrastructures, and intermediaries, and also make meaningful contributions in various regulatory forums and industry working groups. Sriram sir is a qualified chartered and cost accountant and also holds a bachelor's degree in commerce. Sriram sir, the floor is all yours.
Thank you very much, Kundan. I'm very, very happy to be here today, meeting with all of you on a very important subject, and a subject where there's a lot of excitement, a lot of anticipation, and a lot of hope built into a couple of products that we are launching on the 15th of May. This is on commodity derivatives, and as you can guess, I'm referring to the launch of WTI crude oil and natural gas contracts, which are slated to happen on the 15th of May. Well, there are many products that NSE can launch, but why commodities is the question that logically comes to one's mind when one thinks about what can be done at a point in time, right? So we had internal discussions, meetings, and discussion, brainstorming sessions, I would say, where we did go through a number of options that are available to us. But almost everybody in these, everyone that's been in these discussions, sort of, was of the view that NSE needs to be present in the commodity space in a much bigger way, making a much more meaningful contribution to the investors of India. And while we have, already an exchange that deals with and offers many commodity products, derivatives products, NSE has a possibility to make a different kind of contribution to the Indian investors. I am saying this because, the foreign portfolio investors have long been trading equity derivatives on NSE, and they are likely to find it easier to, trade commodity derivatives contracts if available on NSE. So we said, okay, this could be one way of looking at it. What could be the other reasons for NSE to get into commodity derivatives once again and offer identical products on our platform? And so the team members came up with more and more reasons. Today it's so challenging for investors from an operational standpoint. They have to move the collateral to the other exchange, which is an actual transfer. It's not like you can just transfer the collateral from one segment to another. So that, for example, could be an advantage for someone who's looking to trade commodities in addition to equity derivatives. Thirdly, if there is a possibility that, let's say, NSE introduces these products, then obviously, given our stable technology platform, there are investors who already know how our DMA works, how the algo works. It just could be easier for them to get going on this one as well. So after listening to all these viewpoints, we did a number of meetings with a number of investors and other stakeholders across the board. I personally traveled to Dubai, to Singapore, to Hong Kong, and to the US, and spent considerable time meeting with investors and also the other stakeholders, whether it's clearing members, whether it's trading members, and so on and so forth. And finally, we came to the conclusion that it will actually make sense for us to launch these contracts. And that's how we are going live now on the 15th of May. Obviously, at the outset, I want to thank CPAI, who have been such a source of support to us and have always been behind us, trying to support us in every possible way whenever it comes to any new product launches. And this time also, it's no different. So Narinder ji and CPAI colleagues, thank you very much for everything that you do for us, as always. We thought that we should put together a webinar with the participation of outside experts as well, rather than talking about the commodity space and the opportunity ourselves. So in a nutshell, I think there are certain advantages that NSE brings along with the launch of these contracts. Like I mentioned, we have robust, safe, and resilient technology platform. We will be able to offer collateral fungibility across the various segments of NSE. We will be able to introduce the auto trade confirmation facility. We will be obviously able to support multiple asset classes under one roof. All FPI categories are permitted to trade commodities on NSE. We've clarified that out through an FAQ document. We've also said that there is an opportunity for investors to look at arbitrage opportunities between the Brent crude and WTI crude products. So that's an additional motivation. There is DMA, there is algo trading facility for FPIs. Again, that's something that we've clarified. Our clearing corporation is a very strong, robust clearing corporation. It's already rated AA stable. So that's an added plus point from our perspective. And obviously, at the end of it all, everybody knows we are the #1 derivatives exchange in the world. So plenty of stuff going for NSE. But of course, all of this would be futile if we don't have support from member associations and actual investors. So I will want to stop there. And once again, thanks CPI and all the participants in today's webinar for making available your valuable time to be with us today, to learn more about commodities. I'm personally very excited as we get into this journey. And I want to stop here and leave it back to Kundan. Over to you, Kundan. Thank you.
Thank you. Thank you for your kind words, Sriram sir. We are privileged to have you here. I would now like to invite Sri Narinder Wadhwa, President, Commodity Participants Association of India, that is CPAI, to say a few words. Mr. Narinder Wadhwa is the founder and chairman of SKI Group. Mr. Wadhwa has more than 35 years of professional experience in financial services and is a senior chartered accountant and a law graduate from the University of Delhi. He is also an alumnus of Harvard Business School. Mr. Wadhwa is an active member of several industry bodies and has also been an integral part of executive committees at SEBI, at FICCI, and Associated Chambers of Commerce and Industry of India. In the past, he has also served as a chairman and director of Association of National Exchanges Members of India, that is ANME. He was conferred the Pride of India Gold Award by the President of Mauritius and the Global Indian Award by the Bank of Doha in Qatar. He was also awarded as part of Times Now Global Leaders Awards held in Dubai recently. Mr. Wadhwa, over to you, sir.
Thank you, Kundan. Good evening, everyone. I am Narinder Wadhwa, President of CPI. I, on behalf of CPI, welcome Mr. Sriram Krishnan, Chief Business Development Officer, Gaurav ji, Vice President and Head NSE. Team NSE, I also welcome all our members and the participants. I thank NSE team for associating with CPI for knowledge and awareness program today on the launch new contract, WTI and natural gas. I compliment NSE for this initiative for educating and so the development for word, that is NSE. As association, we are always looking for expanding the commodities market with more contracts for value chain participants and the traders. At the same time, we are looking for safer ecosystem for our members and always excited with the important contracts by the NSE. I must say that contract designing and new contract market in the world. And this one is from the commodities side. So we all remember the new contracts. We all were waiting that new offerings will be there from the NSE on the commodity side. And finally, we are here. So when it comes to crude oil, I think my follow speaker will speak more about the crude oil. But basically, there are two grades of crude oil. The most popular being traded is Brent North Sea crude oil and the West Texas intermediate, that is WTI. WTI is usually extracted from US oil fields in Texas, Louisiana, and North Dakota, and delivered in Oklahoma, while Brent crude is extracted from the North Sea and delivered locations vary from country to country. Both of them have a lower sulfur content. Although in our Indian kitty, it has more proximity to the Brent crude, but WTI also has a 88% correlation with the crude oil what we use here in India. As far as crude oil is concerned, energy contract is concerned, what we saw in 2020 was a glut in the crude oil market, and we saw negative prices in the crude oil. So we have came out of it in Indian commodities market. That was a point where we saw energy contracts, less interest in the energy contracts. But I feel that with the new contracts offering by NSE, where there is a bigger reach of investor and the user and the participant chain, there will be a much more interest in this contract. As Mr. Sriram has just mentioned, our 80 to 90% of the collaterals are lying with NCL and the CCs, which are not used after our equity market closes at 3:30. So this contract will offer us a position of efficient money contract, the margin which is lying with the CCs. And another use is again arbitrage opportunity. There is another energy contract in the market. So there is some arbitrage which will be offered in the market. So we are looking for that. Producers, refiners, hedgers, users and investors in India can benefit, access the globally aligned prices and trading practices in this energy contract. In order to ensure that derivative contracts are aligned to the physical market, it is imperative to have a framework to evaluate the performance of these contracts after their launch. So we are hopeful that there will be more proximity and these contracts will be well taken by the market. I once compliment NSE for this initiative to sharpen members' knowledge and skill with CPI, and I congratulate them and wish best for contract. I assure wholehearted support to make this contract a successful contract. Thank you. Thank you. Over to you, Kundan.
Thank you, sir. It was really great to hear so much on the energy space from your words, sir. Really appreciate that. I would now request Mr. Gaurav Kapoor to please take us through the upcoming contracts, WTI, crude oil and natural gas futures. So Gaurav sir is the Vice President and Head Business for North, and he is an engineer and MBA by qualification and has more than 24 years of rich experience in various sectors from manufacturing to chemicals, banking and financial markets. Gaurav sir has a wide experience in the field of operations, product management, customer service and business development. He's been with the NSE for over 15 years now and has played a very important role in launch of new products at NSE. Gaurav sir, floor is all yours.
Thank you, Kundan. Kundan, can you see my presentation?
Yes, your presentation is
Okay.
visible.
Okay. So, continuing with what Sriram and Narinder Wadhwa had mentioned about the launch of crude and NG contracts from May 15th, let me divide my presentation in two parts. One is to give you the background. We've signed, NSE and CME have signed a data licensing agreement, which will ensure that the settlement prices, both for WTI crude as well as for natural gas, is available to NSE. The NSE WTI crude and natural gas contracts will be settled in INR. So these are cash settled contracts, both WTI as well as natural gas. We are also aware that, in commodities, crude, the NYMEX crude as well as the natural gas are the top 5 traded contracts globally. And the Brent and WTI spread is the highest traded, spread of the contract in the commodities market space. The market for crude is incredibly diverse, with the quality and original location of the oil making a major impact on the prices. Because they are relatively stable, most crude oil prices, as Mr. Wadhwa was mentioning, that Brent, they are pegged to either to Brent or to WTI, or there are Dubai and Oman benchmarks also, which are already available. If you see the background for crude, crude is largely based on two specifications. How do you define crude? The quality of crude. One is the API gravity, which is basically the American Petroleum Institute, which is the metrics to compare the lightness of the crude vis-a-vis that of water. And it mainly indicates the oil is lighter than water. So anyone which is having a number greater than 10 or less than 10, that means oil is heavier than the water, and hence the oil will actually sink into water. The other parameter which is there to define is the sweetness, which is the crude oil in any form, which is the sulfur content. So basically less than 0.5% is the sweeter oil is being considered, and greater than 0.5 is the parameter where it is not so sweet. The WTI, if you see, is considered as a very superior quality of crude, and hence the final products are also meant to be of superior quality. Brent vis-a-vis is created by blending oil from, as Mr. Wadhwa was mentioning, it is basically a waterlogged kind of scenario, and the WTI is landlocked, and WTI is largely the West Texas Intermediate, which is in US, and once the crude oil is being being drilled out, it needs to be shipped physically. And but in case of Brent, this is because it is from the seashore, so pipes are being used, and that is how from a transportation standpoint, oil extracted at sea has a certain advantage over the land-based supplies. Because of these factors, both Brent and WTI are being priced differently, and that is how the spreads also are being traded, and they give opportunities for various participants, whether it is hedgers, speculators, or arbitrageurs, largely to trade these contracts. Brent crude generally covers the 2/3 of crude contracts around the world, and because of the supply, it is easy to transport distant locations. The Brent crude contract is available on ICE Europe, and almost 19 million barrel contracts get traded on a monthly basis. If you see WTI, with the average monthly volume for WTI would be around 9 million barrels. And though it is landlocked, that is one of the key drawbacks for West Texas crude to ship to certain parts of the globe. The other one which I mentioned to you is basically the Dubai and the Oman, benchmark, or where it is being pegged to. If you see this slide, the upstream and the downstream companies, what does upstreams are basically companies which dig up the bore wells to sense what is there in the ground underneath to find the oil reserves, and they are the one who actually do the drilling and the extraction of the crude oil. So those are the upstream companies. Just to give you a sense or a relatability, companies like ONGC, Reliance Industries, Oil India are some of the upstream companies. Downstream companies are largely, once the crude oil is being produced, these companies purchase crude oil from the upstream companies and refine those crude oil to various forms such as petrol, diesel, aviation, kerosene, and other forms. And midstream companies are basically someone who transports it. So downstream companies would be typically like BPCL, HPCL, and IOC. So all these companies whom you may be as a retail investor or as an investor maybe investing in these companies have impact on crude oil. And if you see low oil prices are bad for the upstream companies, but suitable for downstream. The higher oil prices is better for the upstream but bad for the downstream companies. In the case of natural gas, if you see, it is found in the deep rock formations, and it is in the reservoirs, and natural gas is usually mainly used in the industrial and commercial transportation and household places. The contracts what we are launching both for WTI crude oil and natural gas, it is going to be a contract which is similar on the other venue, a contract which you are already familiar with, and it also gives, by having the same contract, it will give you arbitrage opportunities to trade a contract and have a better pricing formation also onto the NSE platform. The trading unit for this contract is 100 barrels, and the symbol for this contract is WTI crude. The tick size is 1 rupee. So per tick, basically it will be 100 rupees is what you are going to have a P&L. Leaving aside all other statutory charges are not there. The approximate value of the contract would be around 6.5 lakhs. The margin for this would be 30%, which is close to 2 lakhs. If you see natural gas, it is 1250 is the trading unit, and 10 paisa is the tick size. So effectively, you will be able to make 125 rupees in one tick. The contract value is smaller than the WTI crude oil, which is 2,81,000. This is only as an example. The margin would be almost close to a lakh. So as I mentioned, both WTI crude oil, I've already given you the sulfur would be less than 0.5, and the due date rate, which is the final settlement price, will be the NYMEX front month contract on the last trading day of the NSE WTI crude oil contract. And for natural gas, it will be the final settlement price in Indian rupees on the front month contract on the last trading day of the natural gas contract. And because the contract there will be in dollar terms, so we will be using the RBI USD INR reference rate during the day. So when we launch this contract, both for WTI crude as well as for natural gas on May 15th, which is the coming Monday, for WTI crude, effectively, you will have 5 contracts, which is the June month contract, which is going to expire on 16th of June. So that is the first, the near month contract, which will be available for you. Then you will have July, August, September, and October. And on 22nd May, which is the next Monday, we will open the November month. So any point of time, you will have 6 months contract available to you. In the natural gas contracts on May 15th, when we launch, you will have the June and the July contract available to you. And on 26th of May is when we are going to have the August contract. So any point of time, you will going to have 3 contracts, the near, mid and the far month contracts. As Sriram was mentioning, FPIs which draw huge comfort from NSE infrastructure, largely from the equity derivative space. SEBI has allowed FPIs to participate onto the commodity derivative space only in the cash settled contracts and also in the non-agri commodity derivative contracts and indices. If you see on the what SEBI has allowed, all FPIs other than individuals and family offices and corporates, they will have same client level positions, 100% on par. But FPIs who are individual family offices and corporates will only have 20% of the client level position limit. Let me just tell you what exactly it means. So for WTI crude, the client level limit as per SEBI is around 4,80,000. So this will be client level limit will be because the lot size is 100. So the client level limit will be 4,800 for FPI category 1 and category 2 other than individuals. So that is 100% on par. But for FPI category 2, which is individuals, family offices and corporates, only 20% of the client level limit will be allowed, which is 960 in this case. The factors which are affecting prices of WTI crude, definitely OPEC plays a very important role, both in terms of the prices of crude are largely driven on economic parameters, which is basically the supply and the demand. OPEC can only control the supply, not the demand, and that is how you largely see that there are cuts in the production, and that is how they keep the prices. They try to keep the prices stable or influence the prices in the market. So US crude and product inventories, which is another US inventory data, which is very important. The EIA crude oil inventories measures on a weekly basis. So that is a data point which one should definitely see how much of inventory which US maintains. Then there are definitely global geopolitics. There are other speakers who are in line who's going to talk on the fundamentals of it. And definitely the weather conditions based on which the prices will vary. Same is the case of natural gas, which is on the weather and the price of crude oil and both the international gas inventory data. If you see the volatility of both WTI and natural gas, it's very, very volatile as compared to equity derivative. If you see Nifty would largely be hovering around 14 to 15%, and the volatility both for crude is almost having 34. The NYMEX crude is almost 34, and the natural gas is very volatile. It is almost 55%. So at least the annualized volatility for the last 2 years. But if you see our own equity indices, both Nifty or even Bank Nifty would be slightly more volatile, will be around 17 to 22% in last 1 year to 2 years. So commodity, the crude as well as natural gas are definitely much more volatile, and which means that all the interested parties as importers or people who are on the refinery side, all these people need to hedge whoever has exposure to the crude oil. This is the spread for the WTI crude and Brent, and you can see the spread moves in a very different direction from the way the individual prices move, and that is where largest trading or happens on the Brent and the NYMEX WTI spread, which is the largest traded contract. These are the NYMEX NG months, the near month prices, and they are moving on the upward direction. And the volatility is largely, as I mentioned to you, last 2 years are around almost 50% the annualized volatility. These are the important data which you can refer to and which are there on the monthly, weekly basis. Last but not least, but people who are trading both on the prop side as well as on the clientele side, NSE is waiving of the transaction exchange turnover charges. What it means for a prop member is basically for a round trip of if you buy one contract of WTI crude and you sell one contract of WTI crude on NSE, you will be able to cover your cost in one tick vis-a-vis the other venue. So that's a big advantage. The cost at NSE will be approximately 80 rupees. On the other venue, it will be around 120 rupees. So you will effectively save close to 40 rupees. For a retail member, the cost would be almost a saving of 40 rupees if all charges are being taken care. And here, because it is only as an example, so brokerage has been taken as only 10 per lakh. So it may range different for different members, but effectively you will have saving even as a retail member who's servicing retail clients. Similarly for NG, if you see from a retail perspective, the round trip cost for any retail client would be one tick vis-a-vis the other venue where it will be required 2 ticks. So that's a good amount of saving for any of the retail client of trading on NSE platform. Just to summarize, as Sriram was mentioning, NSE, why someone should consider NSE, not only NSE, but the NSE commodity space, which we are coming and which we are very positive on. One is the robust, safe and resilient technology platform, which NSE provides. The other one is the collateral fungibility across segments, which will ensure that after your equity derivatives, the same money can be used for the commodity segment. The auto trade confirmation facility, which is for FPIs, is very, very wanted and required for anyone FPIs who are going to trade on the NSE platform or any of the venue. So that's very important feature. The other is both FPI category 1 and 2, I have already mentioned, are allowed to trade, and there are nil transaction charges till October 31st. And the larger comfort for FPIs or for any of the members of the clearing member is the NSE clearing and settlement guarantee by the NSE Clearing Limited, which has been rated as AA stable. And we are the #1 derivative exchange, and thanks to all the members and the participants who have ensured that we are #1 derivative exchange in the world. This is the disclaimer because we are using the CME prices. Over to you, Kundan. Thank you very much.
Thank you, Gaurav sir, for your great insights. And I would now call upon Mr. Gnanasekar Thiagarajan, who would enlighten us with the crude oil and natural gas space. Mr. Gnanasekar Thiagarajan is currently the head of Commtrendz Research, an organization which specializes in commodity research and advisory to market participants in India and overseas, having over 20 years of trading experience. He works closely with mostly agribusiness, energy, base metals, and precious metals business corporates in India and across the globe, helping them in managing their commodity and currency price risk. Further to his schooling in IIT Madras and completing a postgraduate software engineering, he had a long stint of 7 years with Dow Jones, one of the leading real-time financial information vendor and promoters of the Wall Street Journal. He actively writes for the Economic Times and is a part of an elite team of experts for moneycontrol.com in providing market insights. He was recently awarded the best market analyst for the category commodity markets bullion by the then Finance Minister of India and then the Prime Minister and the President of India, Mr. Pranab Mukherjee. Mr. Thiagarajan, the floor is all yours.
Thank you, Kundan. Thank you so much. It's nice to be back again. I think last week we did something on the similar lines. So basically, my presentation today would focus on crude oil and natural gas, both as a contract, and what are the key drivers and what are the important fundamental signs that one should look out for, both as an investor and as an institutional investor, and all kinds of investors as a whole. So some of the slides might sound a little basic because I've just gone, taken some of the basic stuff which people should understand. So for the benefit of others who already sort of know this, so please bear with me. So I'll straight away get into the presentation. Kundan, I hope you can see the screen. Kundan, can you see my presentation?
Yes, sir. We can see.
Yes, sir.
Okay, thank you. So this is the distillation process of refining crude. So the reason why I put this up is simply because not many people understand that when you refine crude, there are hundreds of products that come out. It's not just petrol and diesel and aviation fuel and stuff like that. There are so many other products. At each level of refining, you have different products. And by the way, the kind of depth for these products in the OTC market is so liquid and so huge. There are largely MNC banks which quote prices on most of these products. So it's a very deep and liquid market, the OTC market itself. Apart from that, the futures and the derivatives market, especially CME, NYMEX, ICE and all that, they have unlike the domestic exchanges, you have prices for up to 10 years. So sovereign nations also, especially the producing countries, the countries which produce crude, they lock prices right up to 10 years if they feel prices are very attractive. We must understand that there are so much of products, there is so much of liquidity. So it's a very deep liquid market, and there are so many products available for one to look at. So this is how this whole process happens. When you put crude oil and then it goes through a furnace, and then different temperatures, you get different products that come out, and then they're made into products and exported out or used domestically. So that's the market we're talking about. It's not just WTI crude and Brent crude and a few other products. There are so many products available, and they're quite active. It's not that like you say, the Group B stocks in equity markets. So these are cash market products which have a very deep market. Very deep liquidity. So crude oil is a sort of a commodity which has the maximum weightage in the index. There's a Bloomberg commodity index, there's a CRB index, which was there earlier. So the maximum weightage goes to crude oil because, the kind of usage crude oil has across the world. So the weightage is determined based on that. So the FPIs we're talking about, typically the funds which trade in energy markets, look at the weightage on an annual basis. In fact, it happens throughout the year also. But then the beginning of the year, Bloomberg or anyone who's making this index comes up with a sort of a weightage, and they might decrease or increase it based on what they anticipate in the coming year. So I think this year we had a slightly downtick on the weightage for crude oil, which means that they were expecting prices not to do that great. So I'll move out of the distillation process. I think we talked a lot about it. So I'll jump straight into the bullish drivers for crude oil. What are the major drivers? And in that, I have divided into the bullish drivers and bearish ones. So you can see four bullish drivers, I think, are going to play a key role, which is the OPEC, which might tend to keep cutting supplies. We just recently heard that, OPEC went and cut the production, and that resulted in some kind of a surge in prices, but that couldn't withstand simply because there are a lot of demand concerns at this point in time. So supply is not something the market is worried about. And also OPEC is simply doing this because they know that there is issue with demand and prices are going to go down. So as a cartel, for the first time, I'm seeing OPEC bringing everyone together and then holding them together, because in the past we've seen whenever OPEC does anything, the cartel members would exactly do the other way. If they talk about cuts, they will still go about producing more. But this is one time I've seen that they have come up with a clear strategy, and then they have everyone on board, including the non-OPEC country, which is Russia. So I think they would continue doing this as they see prices falling based on demand concerns. And China, rebounding post-COVID. So the numbers that are coming out from China are suggesting that there is recovery. But then what we also have to read through the lines is that, is it a recovery compared to month-on-month, or is it a recovery compared to pre-pandemic and post-pandemic? So if you look at the pre-pandemic levels, I think we're nowhere close to that. So yes, there is some hope, and the way China numbers are coming out, it gives some hope, but we're still not there yet. And then the Russian supplies, which normally is there in the market, is still missing because of the sanctions and other stuff. And the robust demand that is expected, most economies have started coming back in a major way post-COVID. Aviation demand, travel, everything is picking up in a big way. So it should result in more robust demand. But if you look at the bearish drivers for crude oil, they outweigh the bullish drivers. In fact, what I've listed is just 6, but I could have included another 3, 4 more. But these are the key bearish drivers, which I think will play a key role. So the supply cuts which happened, I think, is not adequate in arresting the fall in prices. But they will continue to do it, like I said. But that's one of the tools that OPEC has to sort of put a cushion on falling prices. But unfortunately, it's not really working. It tends to find some momentum and then it fizzles out later, because the demand concerns are really, really overwhelming. The US staring at a potential recessionary, sort of a phase. And the US banking system, which is going through a lot, is clearly putting a lot of pressure on prices. And not many funds, investors are confident about any kind of a major rally that can happen in crude oil prices, both on the supply side and the demand side. Add to that, you have alternative energy, which is eating into fossil fuel demand. We all know about the EV boom that's happening, and even retail. The retail crowd is largely moving out of petrol, diesel into EV. And I think the EV is evolving in a big way now. I myself have an EV car, which is almost 9 months old, and absolutely working seamlessly and saving a lot of energy bills. So I think this trend is going to continue. Movement of the domestic automobile into the EV space, and this is going to eat into fossil fuel demand. So it's a macro sort of a view on crude, that it is this particular factor will weigh on it all the time. For the next 3 years, 5 years, 10 years, it's a long-term bearish driver for crude. Recessionary threats in the US and Europe, like I mentioned earlier, Europe is just trying to come out of the war, and the situation that they went through, energy security. So now they moved largely towards Middle East grades. but the transport cost and the other costs are going to be much higher while doing getting crude from the Middle East. But we won't see the same kind of situation that happened earlier, where there was a major energy security threat for Europe. So that I think they've moved on from that, and the financial market uncertainties is also something which is weighing on the market. But the same funds who trade in these markets also have large positions in financial markets. So they're pretty much aware of where things are right now. If you look at the dollar, it's very fluid right now. There's a lot of negative factors. You have the debt ceiling. They need to sort this out, otherwise the dollar would potentially collapse. So there are many external factors that are also putting weighing on the crude oil prices right now. China demand, like I said, it's very shallow at this point in time, but surely it looks like it might improve. And then geopolitics is going to play a key role. We really don't know how things are going to align, whether this OPEC, non-OPEC alignment will continue, whether US will start putting pressure on other countries to stop importing Russian fuel. So all these things are going to be a key sort of drivers to watch out for. But like I said, the bearish drivers clearly outweigh the bullish ones, and that's what we're seeing in prices. And it's not able to find follow-through momentum; it just fizzles out. So the start of the year, we had some Asian imports of crude oil. But I think that's largely due to the energy security. I think Asia as a whole was worried about energy security on the back of the Russian situation. So there was a lot of imports that happened, but it's come down quite a bit at this point in time. If you look at the last month, numbers are quite low. And you also look at the PMI index, the manufacturing index. That's not at all very comfortable. Anything below 50 sort of indicates contraction. So all these negative factors are at play. And you look at the overall picture, the macroeconomic picture, it doesn't suggest that there is going to be a lot of demand. So that is one concern which markets will be continuously watching out for. And also, the switch to Russian crude and then back is going to be happening every now and then, because as crude prices start moving up or down, so Russia will try to market their crude by giving more discounts. They have to finance a war. So all of this is key things that one needs to watch out for. So having said that, one also needs to look at the inventories which are published every week by EIA. That's a body which gives out information on how much of crude oil inventories are available at any point in time in the US. Because US, went into building these inventories sometime back, and those numbers are quite closely watched. And at this point in time, they seem to be low. So there's a good chance that US could step into, buy for reserves. But so far, they haven't, done that. But these numbers are very important, so one needs to watch out on a weekly basis. So this is the Asian crude oil imports that have come down. So that's basically what I wanted to show on the slide. And the money management position. See, this is something wonderful as far as the US markets are concerned. The kind of transparency that they have. Any position, whether it is whether it's a long or a short position, has to be earmarked as a speculative position or an industry position, as a commercial position or a non-commercial position. So that sort of gives an idea. Suppose the position held by non-commercial, which is funds, which swells up on the long side, then inevitably there's going to be a correction, because funds typically move in and out of the markets. They don't hold on to long-term positions. So that's the reason why these reports are very, very important to keep an eye on. I think Mr. Wadhwa also talked about this event that happened where it went to -40. But this is largely a black swan event, and then it really didn't happen because of fundamentals. It just happened because somebody was sitting hugely short, hugely long, and they had to cover the positions and stuff like that. But the point is that, as investors, these kind of global events can make a big difference in domestic trading. So it's very important, and it's imperative that investors don't, or rather, adhere to risk management properly by keeping stop losses. And I've heard of many stories, many instances where people, I think traders get wiped out by taking a view on the market without any proper risk management strategies. So more than getting the market right or wrong, I think the risk management strategies are very important to follow, and one must keep an eye on that. So this is the chart of the crude prices. I've just taken a macro picture. There's so many other charts to show, but I just picked up a few. So at this point in time, it is kind of struggling in the 62, 63 zone at the lower side, and with the sort of demand which is expected to increase, we could see a test of $77, $80 levels again. That's what we're sort of getting as a view from the charts. But my feeling is, it won't sustain long, even if there is a major, supply concern, and there's some short-term rally. It looks like it won't sustain in a big way. So fundamentally, as far as crude oil prices are concerned, I think it's made a sort of a floor near 62, 63. But still, there is a threat of this floor being broken at some point in time. And my guess is somewhere in the July, August, September period is when it could be broken, because that's the time we're seeing a lot of weakness that could set in. And the various other geopolitical factors, all that could come into play. Let's quickly move to natural gas. Again, the basic stuff is that it's a fossil fuel, and then it contains different compounds. So what happens is, again, just like the crude oil distillation, you have a certain process for natural gas also. It's stored in gas wells, and the storage data comes out every week, just like how you have the inventory data. And it's sort of processed in a particular processing plant. And then it starts going out as different products reaching consumers by pipelines and through sea also, because, when natural gas is compressed using coolants, and then you can transport it as liquefied natural gas, LNG, to various places. So this is the broad process in which it happens. So the Henry Hub natural gas futures, again, if you look at the major supply side and demand side factors, it's the amount of gas production and the kind of storage in the wells, the volume of natural gas imports and exports, either as LNG or through pipelines, or the major supply side factors. So if you look at the demand side factors, the variation in winter and summer weather is very important. We just came out of winter, but it's been a very sort of a normal, I wouldn't say a cold winter. So therefore, demand for natural gas was not that much. The offtake was not much. And the level of economic growth is also very important. We're no way close to those kind of strong economic growth numbers. We're only getting more and more bad news from IMF, more and more bad news from the US markets, which are the large consumers, and the availability and prices of other fuels, like I said, the alternative energy markets. So this is the natural gas storage reports that comes on a weekly basis. So they have a strong impact on how natural gas moves. Again, a word of caution as far as natural gas is concerned. It's a very volatile commodity, extremely volatile, and one needs to be very careful and not take a position unless one is very clear about which direction it's going to go. Even if you're clear, I think risk management strategies, adhering to stop losses are very important as far as natural gas is concerned. Because I've seen so many traders and investors get hit in this particular commodity. We ourselves, don't recommend it to retail investors. We only recommend it to corporates and some of the hedges that we work with. So it's a very, very volatile commodity. So that needs to be kept in mind. This is the inventory data again. And the fund's net long, net short positions in natural gas also makes a huge difference. And right now, they're hugely short at this point in time. You can see this blue lines. That's the period between May to June 2021, Jan 2021. They were long after a very, very long time. And then again, their shorts have increased now. So they're hugely short at this point in time. And the charts are sort of indicating that we're somewhere close to a bottom, just like crude finding support at $62. Natural gas is also closer to this $1.4550 supports in the international markets. And we must be testing that soon. We are not there yet, but we should be testing that soon. And prices should find a floor there. So it's presently stuck at $2. So that's the view for natural gas and crude oil on the fundamental side. And I'll be happy to take more questions if anyone has any queries after the end of this. Cheers and thank you all. Thank you. Back to you, Kundan.
Thank you. Thank you, sir. Thank you for the brilliant insights on the energy space. You have really explained all of it in such simple words. We now call upon Mr. Himanshu Arora, who is a market expert and an empaneled faculty at the NSE Academy too. Mr. Arora has more than a decade of experience in imparting trainings. Mr. Arora has appeared on various business shows on TV channels like CNBC, 18, Z Business, etc. Also, he has been quoted on various financial websites like Reuters and Commtrendz, etc. He has a rich academic experience and has also been associated with many colleges and various financial establishments of high repute, like the National Stock Exchange, NIFM, that is Ministry of Finance, to name a few, for delivering lectures on different subjects in finance. Earlier, he had served at Commtrendz Partners, a research and consulting organization, as a consultant and a senior research analyst. Mr. Arora's previous assignment was with Religare Enterprises Limited. He's an engineer by qualification and has completed post-graduation from IMT Ghaziabad. Alongside, he is a CFA Level 2 candidate. Mr. Arora requests you to please share your expert thoughts on crude oil and natural gas.
Thank you so much, Kundan. Thank you so much. I hope I am clearly audible to you.
Yes, you are very clear. And
Okay. I would like to start sharing my screen with everyone. Could you please just confirm me if the screen is visible?
Yes, now it is. I can see the investing.com slide.
Yeah, perfect.
The page, sorry.
Perfect. Thank you so much. So yeah, hi guys. I also happen to be associated with, I am an active participant in commodity market for almost 15 years now. So I have been an analyst for the bullion and the energy market. And also I happen to be a trader. And talking about, I'm taking forward to what Mr. Gaurav mentioned, that there are three kind of companies that are associated or that deal in the crude oil market. So one of them being the upstream companies and the midstream companies and the downstream companies. So all of them are, they draw their profitability from the commodity prices, especially the crude oil and the natural gas prices. So when you are drawing your profitability or when you are very closely linked to the prices of certain commodities, it means that the prices are going to impact you. So today, whatever time we are together, I will mostly be talking about the prices of these commodities, because when some treasury or when some corporate is dealing with the prices of the commodity markets, they are broadly impacted by the upside or the downside, or basically increase or decrease in prices at a broader level. So I would be covering, I would like to cover with you today, like, can at a very basic level, can we determine where the prices may be heading so that we may either hedge or we may either mitigate our costing or we may mitigate our price risk? And at the same time, if you are not a corporate, if you're an individual, if you're a trader, if you're a retail participant, then maybe again, the price discovery or finding out the prices you may use for some other purposes also. So I have opened this crude oil prices on this website investing.com, and I would like to just show you at a very basic level that at a basic level how you can find out where the prices are heading. But before we even talk about it, there is one thing I would like to tell my fellow participants here, that why commodity market is slightly different than any other markets. So let me just open a blank page here. So let's try to understand this way. Now, for example, some of the product, let's say some stocks, some stock called ABC. So some stock may go up from, let's say it is trading at 100 rupees and it can continue its journey to 120 rupees, 130 rupees, 140, 150, and so on and so forth. And because even if it is based on a natural demand and supply, I am not saying that the prices are being manipulated by someone. Even if it is a very basic demand and supply, the prices can increase sharply from 100 to 150 to 170 to 180. And no one is going to bother about it. Even if the prices fall from, let's say, 100 rupees to say 30, 40, 50% downside, and the prices have fallen to, let's say, 40 rupees or 50 rupees and so on and so forth. Again, no one is going to save the prices. Of course, there will be speculators. Of course, there will be traders who would like to get a benefit out of this opportunity and may like to accumulate this stock, or they may like to profit book their stocks here and exit the stock if they are holding in their portfolio. But no one is going to safeguard the prices at a lower level. The intention will not be to pull the prices up. The intention of the participants will broadly be to make money in the market. But on the contrary, if we look at some product, for example, USD INR, if the prices of USD INR, they go up from 82 to, let's say, first, it is very unlikely that the prices of USD INR will go up by 10, 15, 20% anytime soon. But hypothetically, let us even assume that the prices go up from 82 to, let's say, 90 rupees. That's a 10% massive increase. I am very sure our regulators will be worried, and someone in the world will be worried if the dollar prices have gone up significantly, and there will be huge supply building up at higher levels, which is likely to bring the prices down, which was not the case here. In the similar fashion, even if the USD INR prices have gone down from 82 to, let's say, 70, then also it would be bad for someone, and someone would try to accumulate the dollars to pull the prices higher. So someone will be there to support the prices. Now, interestingly, the commodity market resembles this kind of market, wherein if the prices are trading currently at $60 per barrel, and they may move up sharply to, for example, $90, $100, $110 per barrel, there will be some suppliers like OPEC or US. They are likely to increase the supply because the crude oil production is now becoming a very profitable proposition for them. In the same way, if the prices have fallen from $60 per barrel to, let's say, $20, $30 per barrel, it is becoming a very profitable proposition for countries like India, China, Japan, which are likely to accumulate oil here. So the point I want to put forward here is that in case of certain markets like equity, especially, for example, the mid-cap companies, the small-cap companies, and so on and so forth, so all these kind of stocks may keep on, or all these kind of products, I'm not just talking about equity, there are many other products like that. So they may keep on going up or going down in one single direction for a very, very long time. While there are certain other products like crude oil, as we mentioned, these are called the trading products, which if they go up significantly in one single direction, they may get tired relatively sooner compared to certain other products. So broadly speaking, there are two kinds of products in the market. One is called the trending products, while the other are called the trading products. By this word trading, I do not mean to use I do not mean to say the trading thing that we do in the financial markets. I am saying that the products that take a very single direction for a very long time are generally referred to as trending products, while the products that may keep on moving in one range, even though the range may change, but these products are likely to move in one single range for a very, very long time, or rather I would say they are more likely to trade in a range for a very long time compared to other products. Which brings us to a very important conclusion that now, if you want to find the direction of this kind of product, the trading product, it will give you opportunities twice. One, when it is moving in one single range for quite some time, then also you can find out the direction and get a benefit out of it. Whether you are a speculator, you are a hedger, or you are any other participant in the market. So one, you can make money here, or you can find out the direction here. At the same time, you can also find out the direction here when the market is likely to reverse, when the market is about to reverse, or when the market reverses, because reversals in these kind of markets are more frequent compared to reversals in these kind of markets. So first, let us start talking about how to find out, or how in a very basic manner one can find out the reversals in these kind of products. So for you, I am looking at this investing.com chart of crude oil, and that happens to be a WTI, West Texas Intermediate only, which is currently trading at $73 approximately. $73 per barrel is the current market price for now. Now, as you all are aware that in technical analysis, which is widely used to understand the direction or to gauge the direction of the markets, the technical analysis either uses price action or it uses some technical indicators. Let me, in the next few minutes, let me just simply apply an indicator called money flow, just so that you can see it pretty just so that it is clearly visible to all of you. I'm making it a bit darker one. So now, at the same time, I am using another candle, which is Heikanashi. Heikanashi basically in Japanese means average of candles. So what I have done is I have become very conservative. I am now thinking from the eyes of a treasury department who needs to find out, or an active treasury department for an upstream or a downstream company of a crude oil, or if you being a speculator, you can also think through those lenses. Now, this being the average of some candles and this indicator at a lower level, it tells me whether the money is flowing currently in the product or not. And this is going to help us find out whether this downside is sustainable or not. Now, as you all can see here, I'm going to share a very simple strategy. Now, you see that the prices have been going very sharply down. This is only a few days ago that the prices in the crude oil were down by almost 10% in a very short span of time. Now the question arises that the product generally moves like this. As we discussed earlier, the product generally moves like this. Now the question is the current upside trending in nature, or is the current upside likely to reverse anytime soon? The only idea that we have today is to find out whether this downside is sustainable or not. Now, along with the fundamentals that one of my fellow trainers discussed with you in the previous previous talk, let us try to find out that whether this downside was sustainable or not. Now, the prices suggest me that there is a sharp downside, there's a sharp supply in the market. But the money flow index, it tells me that this time the prices, the downside, look at this level, the downside was very steep in the money flow, while in this case, if I mark a line here, it has not broken any low of the previous money supply, which means even though the prices are going down, the money supply with which, or the money or the aggression with which the prices are going down is not very aggressive here, which means that the downside might be unsustainable, which in turn implies that if we are dealing with crude oil, we are actually dealing with this kind of scenario where the prices might reverse from here. So now you see, when the average of the candle starts going up, this is where we notice that the prices have sharply recovered, which means that though it was a very sharp downside, but this downside was not accompanied by a huge amount of money. So if you happen to be a speculator, if you happen to be a scalper, if you happen to be any hedger, if you happen to be part of any treasury team for whom the direction becomes important, these kind of indicators can be used day in, day out basis. At the same time, if we look at this pattern, the prices are even though going up, but the money is still not flowing into the market. Every time when you will notice that the prices are going in a single direction, but the money is not flowing. For example, let me show you one last example here. The prices were making higher high, but the money flow was not making a higher high. It means that even this downside is not sustainable. And then we saw the market plunging to some lows. Last but not the least, another kind of thing that I discussed with you, that even for finding direction in these short terms, even if you want to find the direction, then some other indicators like moving averages. Let's say I have applied some couple of moving averages here. The moving averages can help you find out the short-term directions. So all these things, fundamentals and directions and technical analysis, can help you find out the broader direction. And also, so either here, or if you want to catch the reversal for any reason, all these kind of fundamentals and technicals can help you find out the direction in the short term as well as in the long term. So because of paucity of time, I will not be taking much time of yours, because I think, Kundan, we should be taking some questions also. So broadly speaking, using fundamental analysis and technical analysis together, if we can use both the things together, then it will be easy for us to determine the prices also, and whether you happen to be an upstream company, a midstream company, or a downstream company, or you happen to be a speculator, or you happen to be certain kind of hedger, any kind of participant you are, all these kind of indicators, be it PMI, be it US non-farm payrolls, be it an inventory data, EIA inventory, and so on and so forth, supported by some technical indicators, all these parameters are going to help you in trading this wonderful product, crude oil, which happens to attract 6% of the global trade volume amongst the billions of products that are traded across the world day in, day out amongst different countries. One product, crude oil alone, attracts 6%, more than 6% of the global traded volume in the physical products. So that's it from my side. Kundan, over to you, please.
Thank you. Thank you, Mr. Arora. This was, a superb technical. You have explained the technical analysis so well with real-time charts and indicators. Thank you so much, Mr. Arora. Now we come to the question and answer session. I have seen a couple of questions on the screen, and I would like to answer them. Give me a moment, please. Oh yes, a few questions which, of course, I can answer to. So, Mr. Arun has asked, is the expiry cash settled? So yes, this is a cash settled. There is no physical delivery of oil and natural gas. It is a cash settled product. Mr. Ghosh has asked, what is the lot size and can we trade in options? So the lot size for crude oil is 100 barrels, and for natural gas, it is 1,250, 1250 MMBTU. This is the lot size for crude oil and natural gas. We have not launched options in both. There is a guideline by our regulators for options to be launched. We may launch options later. Then we have a question on what are the opportunity by trading, by introducing these, and how will it be beneficial for us? I remember Gaurav sir has very well explained in one of his slides about the opportunities and why to trade at NSE commodities. Gaurav sir, would you like to take that?
Yeah, Kundan, I think one definitely most of the clients as well as members are connected to NSE. That is the primary reason. The second one is, the collateral fungibility. The collaterals which are available for equity segment can be easily utilized and moved towards, commodity segment. The third is the most important in product like commodities, actual users. So FPIs uh, are allowed in commodities. So, and they have huge comfort from NSE infrastructure, both at the trading front end as well as the clearing side. So that's an other key advantage. So direct market access and algo trading facility also are allowed for FPIs, both category 1 and as well as for category 2. So largely these are the 3-4 areas where I think people should look at advantages from NSE commodities. And then one more thing which I wanted to mention, members who are here, if they want a training session for their dealers or for their clients, we'll be more than happy to engage with them, the relationship managers. And the commodity contract is also available in the test market and the simulated market. So anyone who would want to test their strategies or want to develop their strategies, so the contract is available in the test market as well as in the simulated market.
Thank you, sir. One more question. This I think Mr. Thiagarajan would want to answer. So, okay, so Srinidhi P. Yadavati has asked from Dharwar that on what basis are you going to fix the price crude oil future contract after sanctions? So I think we are speaking, Mr. Srinidhi would want to speak or was wanting to ask about how Russian sanctions have been playing a role here. So part A, we are going to take CME prices for settlement. Part B, on crude oil sanctions, the Russian sanctions, anything on the Russia-Ukraine status and sanctions, Mr. Thiagarajan, would you want to comment something on this?
Yeah, I think it's well known that the last couple of years after the conflict began, these sanctions have had its impact, but it's had a very limited impact. So the knee-jerk reaction was there for a period of time, but I think the market got over it once it understood that there isn't, a clear energy security, because Middle East was ready to pump as much and compensate for the Russian supplies. So I think even going forward, if there has to be more sanctions, if for any reason, it will be for a limited period of time. So there could be a knee-jerk reaction, but it won't sustain. That's the sense we're getting from the way these sanctions have worked so far.
Great. Thank you, sir. A few more questions. Can we expect a mini contract also in future? Yes, Mr. Gaurav. Yes, you may expect mini contracts in WTI and natural gas. The product team is here with us in this forum. I'm sure they are also in the pipeline of discussions and regulatory approvals. So if Mr. Vivek Jalan is here on this forum, would Mr. Jalan want to comment something on this? Vivek sir, Mr. Vivek Jalan heads the product team of our commodities, and he's part of the product team. Vivek sir, we are not able to hear you. Would you want to pass this question to Anup from your team?
think so. He's facing some technical difficulties.
I understand. Anup, would you be able to answer this question?
Sure. So the mini contracts, as you rightly said, that is something which is in the pipeline. We wanted to focus first on the main contracts, which is the 100 barrel and 1250 MMBTU contracts. And after these contracts are launched and we see good participation in these contracts, which we are sure of it, we will be launching the mini contracts soon as well.
Great. Thanks, Anup. There is a question from Mr. Rahul Shukla. What is the correlation between crude and natural gas? Himanshu, would you want to take this question?
Yeah, sure. The real numbers are currently not available with me, but they both are very closely related to each other. So the correlation would be high, but I need to check the real numbers for now. The various derivatives of crude oil, because most of the crude oil that we pull out of shale, that Mr. Gyan sir were also talking about. So whenever we pull out the crude oil from shale, and shale happens to be one of the largest producers of crude oil, that is more than 20% today. So the natural gas automatically comes out of that. So because the source is same for a lot of crude oil in the world, so hence they happen to have a very high correlation. Yeah, the numbers need to see on them on some sheets there.
Great. Thank you, Mr. Arora. Well, we have already spoken on the specifications of both, for which I'm getting a few questions. Okay. Right. So there is a question from Mr. Rao. Is spread margining benefit available, like for reduced margin for protective put, credit and debit spreads and protective calls? So, Mr. Rao, as mentioned earlier, we are not coming out. I mean, of course, there's still more time for us to come out with options for these two products. As of now, yes, the spread margining benefit is available for future contracts. Like when you speak about buy the current and sell the next month, yes, there is a margin benefit available. But we aren't coming out with options in this very near future. It might take a little time.
Just to add to what Kundan is saying, the margin benefit would be almost 75%. It will be 75%.
Thank you for that, sir.
And also, Kundan, I would like to add here that the spread trading in crude oil internationally, in the crude oil as well as in natural gas, they both are a widely followed methodology by the traders across the world. So in India also, we are expecting it to pick up this kind of trading anytime soon. So this is one thing that the current month and the next month calendar spread. So that is something that is not as much as we see in the international markets, but we see the kind of traders building up in Indian markets anytime soon.
Very true. Very
interesting
true.
Form of trading that would be building up.
Very true. Very true, Himanshu. Very true. Okay, one more question, which I was just trying to see. So yeah, I think we've done with all the questions. Okay, one very important question was from Mr. Rajesh. Does alternative risk management framework apply with respect to margin? So let me tell you, yes, if the prices go negative, yes, alternative risk management framework will certainly apply, Mr. Rajesh. And of course, the details are there mentioned in the consolidated circulars as well. So I hope we have catered to all questions. But nevertheless, if there are any more questions, we can always you can always email us, you can always call us up, you can always get in touch with Mr. Wadhwa, Mr. Kapoor, and of course the entire team. And over to you, Gaurav sir.
Gauravji, small question.
Please.
Are these contracts available on the CTCL platforms, which are like Odin and other platforms? They have adopted it, or NSE commodities kind of thing?
So, I could not hear your question. Are you saying it is available on other platforms like Odin and all? That's what you're saying?
Yeah. Other
So yes, sir.
CTCL.
Odin, Omnisys, most of the CTCL vendors which are empaneled with NSE, so it is
They are
available.
offering that.
Even
They are
back
offering.
offices also are ready to offer this product, whether it is Shilpi, LD. So from an infrastructure point of view, both front office as well as back office is ready. Even algos also are ready,
Are
sir.
available.
Yes, sir.
Okay.
Yes. So thank you, everyone. Okay, and thank you to CPAI, Mr. Narinder Wadhwa, for helping NSE to reach out to members and as well as to the investor class. This program was being streamed on social media, YouTube. So many of the participants have joined there. These are series of reach out programs which we are trying to do across pan India. So we've done one recently in Chennai. We've done today for Delhi, and we are planning for other regions as well. So the larger purpose is to sensitize and reach out to all the participants for the benefits of the newly launched contracts. Thank you once again. Thank you to all the high-profile speakers, Himanshu, Mr. Thiagarajan, and everyone. Thank you once again.
Thank you.
Thank you, everybody, to listen to us, and we come to the end of the session. And thank you very much, CPI. Thank you, sir. Thank you to all the speakers, Gaurav sir, and entire team. And
thank you.
Have a nice evening. Thank you.
Thank you.
Thank you. Thank you, everyone.